Invest in farmland by learning how to ride the wave. Hi, I'm Patrick White, and I'm a broker associate here at Agriland Inc. Farm Management and Realty in Spencer, Iowa. I'm a second generation farm manager and a fourth generation farmer, and I'm going to show you today how to invest in farmland by learning how to ride the wave. And I'm going to show you the wave that farmland takes, that land prices take over time, and I'm going to show you how to be the guy on the surfboard here and do a great job riding it. Why farmland? Because honestly, they're not making it anymore. As you can see from this metric here, it shows that the acres since 1998 are in a pretty significant downtrend over time. I mean, yeah, there's some CRP in there, but your principal crop acres are just on a downtrend. And what is that due to? It's due to things like urban sprawl, people building houses on top of previous cropland, and a lot of it's due to electricity production too, putting windmills out in the middle of crop fields with roads going to them, and then of course solar, things like that. So all that as the demand for electricity and the demand for homes keeps going up, it's definitely puts a pressure on the amount of cropland left available. And the expected consumer growth rates here for this decade from 2020 to 2030, you've got your upper middle class here looking like it's going to increase up to 1 billion people. That's a huge deal. That's a 400 million person increase. The lower middle class is going to be up by about 900 million people, from 2.9 billion to 3.8 billion. And then you look at the rest of the world that's not in the middle class or higher, that's going to be decreasing by 600 million people. And all these people, as they get more money and they go into the world middle class, they're going to demand a lot more goods. And the first thing they're going to demand is a lot more red meat in their diet. And that takes a lot more grain to make that meat and to improve people's diets. And obviously it makes their lives better, but it also demands a lot more from the acres of land that we've got left. So we've got a situation where we're losing cropland, but then we're asking that same cropland that's left to do more for the world growth. And a lot of this growth is happening mostly on the Asian continent, like in India and the Southeast Asia and things like that. And it's really good that they're getting into the middle class, but also it just puts more strain on our farmland. And that's why farmland is a really, well, in my mind, a safe but just a very resilient asset to be a part of. So in my research, there's been two main ingredients to a land rally over time. I've been looking at this since the late 70s and then into the 80s, and then of course into today. The two things that are always before a major jump in land values is, number one, low interest rates, and then number two, a rally in commodity prices. So if you can have a time of low rates and then we have a big swing higher in commodity prices, that's going to be the next wave higher in land. I mean, it seems obvious, but we've gone through a lot of times where there's been low rates for a long time and low commodity prices, and the land value just kind of stays there. So what you need to do is you need to find times in history when we have low interest rates or lowering interest rates, and then right before the next swing in commodity prices higher. That is 100% the sweet spot to buy land. So here we have a chart of interest rates over time. So like in the 70s, they rallied and they went down into like 1977, 1979 timeframe. That's when inflation really started going. So like when my dad was in high school and going into college, inflation was just rampant. And so what did they do to curb that inflation? They raised interest rates. And this is the 30-year, or no, this is the bank prime rate interest rate. And it actually peaked out in 1981. And then it's kind of tailed off from there. And it's a little bit hard to see here, but we basically in 2009 it went down to almost nothing, and then it rallied, and then into COVID it went down to almost nothing, and then it rallied, and now it's tailing back off again. So interest rates are going lower. They've been a lot lower in the past, but they've also been way higher in the past. I would argue that where we're at right now is it's about a 6% interest rate. I would argue that's a little bit less than a normal rate. But it's still, a lot higher than what a lot of people have been accustomed to. But I think it's more of a normal rate. But it is going down. It has been going down here about the last 6-12 months or so. So in here, we've got the commodity prices over time, and you'll see these big swings. So basically, like in the 70s and into the early 2000s, we were basically stuck in this lower channel. This is the 6-month chart. So every bar is 6 months of corn plus soybeans plus wheat in the nearby charts. So this is all three of them just all added together. And you'll notice that we had a nice rally going into 2008, and then we had the global financial crisis in 2009, where basically the world was broke. They didn't have money to buy food. And then we rallied into 2010. We had a shorter crop. And then 2012, of course, we had the historic drought over the Midwest. and that gave us our rally in corn, soybeans, and wheat. And then we had a period of time from 2013 until 2019. It was 6 years there where commodity prices really tapered off, and they were really bad, really since 2015 to 2019. And then they rallied again in 2020, coming out of COVID, when we had the derecho in Iowa and the USDA underestimated the corn crop. And then we had three droughts really back to back, 2020, 2021, and 2022. We had really short crops. So we rallied and made a new high in 2022. And then we went down in 2023, 24, 25, and now here we are just starting 26. And I would argue that our commodity prices of corn plus soybeans plus wheat are going back to their base levels, and it's going to look like this 2014 to 2019 here for however long it takes to get a weather rally again. So this is the chart of the Iowa land values and it's inflation adjusted. So basically, like what I was talking about earlier, we came out of the 70s. We had this high inflationary time period, and our land values really reflected that. And basically, we went from $2,000 up to about $8,000. Now this is inflation adjusted, so it was actually a lot less. It really went from about $1,000 up to about $3,000 or so, and then it crashed in the 80s. So in 1981, when we had all those, the peak prices, it really, took it to the farmers. And what happened in the 80s, really, even though the rates peaked out in 1981, it took until 1986 to get those rates out of the system. And really what happened was the people that owned the land had variable interest rates. And so as rates went higher, they just straight up couldn't pay their mortgage. And so not only did the high rates stop new buyers, but they also forced the existing owners to sell. So we had a situation where there was a massive oversupply in the supply of sellers, and then a massive undersupply in the demand for buying it. And the result was land going back under $1,000 an acre after it had previously been about $3,000. So, and that took a long time for people to get their confidence back. I mean, it really took until like the early 2000s when we started having ethanol plants come into the state of Iowa to really get things going again. And it's almost like from 1986 to 2000, 2001, 2002, that all those 16 years of gains that should have been happening that didn't really happen or were slowed. It was kind of just all this pent up demand, and that's where you kind of see, in this ethanol boom time frame, in basically the early 2000s into 2010, we had just a precipitous rally in the land market. And then that kind of went into, we had a little bit of dip for 2009, but that only lasted a year. And then 2010 was higher, 11 was higher, and then the 2012 drought. And there was still a lot of enthusiasm in 2013, and that's what ended up peaking the market. And if you notice too, during those times, we had lower rates. So during that time, basically from 2009 after the financial crisis, into about 2015, 2016 timeframe, we had really, really low rates. And they were starting to go up in 2016. And then, of course, COVID shot them back down. But with the higher commodity prices that we saw in 2010 and then 2011, 2012, of course, 2013, that's when we got this major jump here. And it was the low commodity prices, or the higher commodity prices and the lower interest rate. That's just the formula. So if you notice in 2013, we had a peak then. After 2012, we had a peak in our commodity markets and they went down. So in 2014, 2015, 2016, 17, 18, 2019, I mean, that was year 6 of some really poor commodity prices. Prices were back at their base values, but we still had, relatively low rates. I mean, you could still finance a farm for a little bit over 4 and change, something like that on a 30-year mortgage. But then if you look at this, we had our next leg higher in the post-COVID rally. The U.S. printed a lot of money. I believe they printed 25% of all the dollars in existence up until that point in the year of 2020. So what happened was inflation naturally just went rampant, and then and we had low prices, and then on top of that we had the derecho and we had the drought in 2020, 21, and 22, and that gave us our higher commodity prices in the face of the low interest rates, and that gave us our final leg higher. Now in 2023, we peaked the land market, okay? In 2023, we had a lot of good farms, like in Clay County, they went over $20,000 an acre for the first time. People couldn't believe it. The prior highs were like $12,000, $12,500, stuff like that. And it's always kind of funny because every time every time we have a rally and we make a new high, it seems like there's always some random actor that comes in and just spends buku dollars on any farm they can buy, and they way overpay. And then all of a sudden, we go back to we overproduce commodities. First of all, we have lower commodity prices, and then we end up having higher interest rates, and that just sets this back. So right now we're sitting in the beginning of 2026, and we've had basically 2 years of a slide in prices, in land prices, but they haven't really been nearly as bad as of a setback as what they were like in 2018, 19, stuff like that. So right now, I think we're probably not quite out of the woods yet on some of this stuff, but there's still a lot of deals out there to be had. Like what I said with those $20,000 an acre farms in southern Clay County, they're now selling for about 15.5 or so, 16,000, maybe somewhere between 15 and 16,000, which is 20% off the high. In my mind, it's a pretty good deal comparatively to the last couple of years, and you're not setting records. Okay, that's definitely not what you want to do here if you're trying to make a good investment. But I don't think they're really going to fall apart though either. I mean, there's a lot of base value in this land, and farmers still have some money here. It hasn't been too many years of tough times, so there's still a lot of money out there to support these things, and just the way the world's the world middle class is growing and things like that, and our biofuel demand and things like that. There's just still a really bullish future for agriculture. Does that mean we're going to go to the moon next year? Probably not, but in the next 5 years, I think there's a good chance. So how do you capitalize on this as an investor? Well, I'll just tell you straight up, you can't ride a wave without a surfboard. You have to buy a farm. You have to own acres in order to participate in this cycle. Commodity prices are at their base values again. We've got corn in the fours, the low fours. We've got wheat in the fives. We've got beans back at basically $9.60 to $10, right around there for cash prices. So really, commodity prices, they're not setting records. They're back at their base values again. Interest rates have been inching lower, but they could still go lower. We kind of had our peak here this last year, and at least for the short run. And of course, the president wants a dovish Fed share, and they're probably going to replace the Fed share going forward. So I think rates are going to continue to go down as long as inflation is curtailed. And I think they've started to curtail inflation just a little bit here on at least some of the items. But interest rates, I'd say, are either going to stay stable or go just a little bit lower. And so when rates are like this, when they're lower, all you need is just basically a weather event to rally the commodity prices, and we're going to get our next leg higher. Now, this low interest rate and low commodity price type of environment typically lasts about 4 to 6 years. Think back to 2014 to 2019. That's your prime example. We had low rates, but we had bad commodity prices. So basically, 2026 is set up to be the fourth year of this type of low interest rate and low commodity environment. So 2026. Really, I think in my mind is set up to be a year where you could find the right farm and not overpay for it. Find a farm you can improve upon and go from there. And I think you would set yourself up for the next 3-4 years of the chance to get higher prices and then the next leg higher on this land. So partner with Agriland, work with the professionals at Agriland Inc. and buy the right farm for your goals. We are actively buying farms for ourselves and also for investors, and we know what kind of farm that can maximize your land investment. Last year we bought a farm, and then in 2019 we also bought a farm, like just personally. We're buying farms about once every 5 years, which I'm pretty proud of that pace. But it's also a lot to be said with getting the right farm. And in my mind, the right farm is a farm that is in a good area and it's got pretty quality soil, but it's something that you can improve. I think the biggest thing is you don't want to buy a perfect farm, just like buying a perfect house to rent out or something like that. Really the money is found in the improvements, or at least that's been my experience here in my career. This is that the money's been found in the improvements. If you can take a farm and make it the best it can be, that's something that will sell for the best it can be in the future. And at Agriland, we help analyze deals and maximize your tax benefits. We manage the farm as well, and we just help investors avoid common pitfalls. We can tell them, hey, that farm for that kind of money is too much money, or it's got this problem or that problem, or maybe it's the opposite. Maybe it's it's got this kind of opportunity, it's got that kind of opportunity. Really, with our local market expertise, we can really help you just avoid big pitfalls. So contact me to go ahead and get started today. I'm Patrick White. Like I said, I'm a real estate broker associate here at Agriland Inc. Farm Management and Realty in Spencer. I'm a second generation farm manager and a fourth generation farmer myself. And there's my credentials. And thank you for watching.